This conference will now be recorded.
So, welcome to this edition of Traders Exchange. As always, everything that we're going to be talking about today is for educational purposes only, and nothing is intended as any type of investment advice. All right, so before we get started, we do have a bunch of questions, but I want to bring something up really quick, and it's something that David posted that just really stands out, and it doesn't matter what part of life, whether you're trading, whatever you're trying to accomplish. And I want to read this out for you guys. So the process versus the outcome. When you are more concerned with the outcome than the process, shortcuts are considered. Distraction is inevitable. Complacency is expected. You feel rushed and overwhelmed. Unrealistic expectations lead the way. Time feels like it's working against you. The results may not be enough. But when you are more concerned on the process than the outcome, the detailed matter focus is the forefront. Daily routines are implemented. Habits become lifestyle. Habits become lifestyle. That really stands out. Patience is acquired. Humility is enacted. Moves are intentional. Value is over-delivered. Time is working for you. The results are an endless byproduct. Mastery is created. Now, I don't know if everyone read this, but wow. I mean, if this doesn't break down trading to a T, and like I said, it's not just trading, it's anything that goes on in life. It just shows you it's the change of your mind. It's literally developing, and you're talking about your mental neurons getting to a point where it's like I said, it's like riding a bike. It becomes second nature, but it's all about the process. And we have some really good questions that are coming up that have to do with process based off what I saw. Like I said, I never read the full questions before because my best answer is always going to be what I think of at that moment, because that's just how our minds work. Especially as a day trader, we have to be ready for anything that could happen. And this is kind of a lead into our first class that's going to be coming in tomorrow. But guys, this is real strong. And it's something that you should read over and over again and really, and figure out, which person am I? Am I the process or am I the outcome? Okay. Do I want to make $10,000 today? Or do I want to trade the high percentage trades? And, we talk about all the time how money has no place in trading, and it's so contradictory, but at the same time, it's so important to understand. So I just wanted to point that out if anyone did not see that, because it's imperative. Where can I get a copy of that? Food for Thought channel in the chat, Keith. All right, so let's talk about some process. First question, as a new trader, is it better to focus on one stock, or would it be better to immerse myself with multiple stocks to simulate how a regular trading day would be? I understand that practice makes perfect, but to me, quality practice is better than quantity practice, which there's no question behind that whatsoever. What is the best way to achieve this quality practice? Thank you and for your time and help. So this is an absolutely phenomenal question. But one of the things that I noticed as soon as I read it was simulate a regular trading day. Do all of us have the same regular trading day? Does every person in here have the same exact regular trading day? Nope, not even close, right? There's someone that just started a week ago. There's someone that started a month ago. There's someone a year, so on and so forth. So there's each person, it's completely different. How many of you guys trade one stock at a time? How many of you trade two stocks at a time? How many of you trade three stocks at a time? So one of the things that you have to understand is that if you're, depending on what stage you're in, you should not be trying to trade more than one stock. So, one of the things, especially when you're in a chat room, is you see people at all these different levels. We call out, 10 different stocks within a 20-minute time period. Because we've basically grown the ability to be able to look at that many things at once. If you're just starting out, what do you think is the best number of stocks to be watching? One. So in the beginning, okay, for somebody that's first starting off, one stock at a time. And when I say one stock at a time, I don't even mean to that you're only focusing on one stock at a time, but you have 12 other stocks up. That's not even what I mean. I mean, it's so important to build the ability to understand if a stock is going to move. Anyone ever get caught up in a stock and watch it for 20 minutes and it does absolutely nothing and ends up building for the rest of the day? Of course, we've all been there before, and just focusing and focusing and focusing, and it just doesn't give you what it shows it has to do. So the time frame is going to be completely different. So in the beginning stages, it's so important to first focus on being able to basically define a stock that is going to be able to move. So focusing on one stock, yes, you're not going to see everything that's going on in the market, but it's not meant for that. Because what happens if you keep picking stocks? Okay, the beginning stages, remember, is always going to be your foundation. So the most important thing in trading is the stock to move, isn't it? So what's more important than being able to define and be able to pick out, today's list, what had 1, 2, 3, 4, 5, 6, 7, 8, 9. We had 10 stocks on our list this morning. All right. Is anyone going to be watching 10 stocks the second the market opens? Well, I mean, some people, but do you understand what I mean? So it's so important to be able to take those 10 stocks and pick the right one. Now, it doesn't happen right away, but in the beginning, that focus is going to help you to be able to take a list of possibilities and shrink it into what you actually should be looking at. So there's no such thing as a regular trading day, because a regular trading day is defined by the person that's actually trading. If you can't, if you're, basically, your first couple of years or in that area, what you want to do is you want to be able to find a stock that you can read the story through, a stock that's going to move, a stock that has possibilities that are going to be able to, to really show you how screen time works, how a stock, the different possibilities when a stock goes, for instance, we could talk about a stock in a consolidation. Consolidation has a few different possibilities. Technically 3. It's either going to stay in consolidation, it's going to break out up, or it's going to break out down. So you want to be able to utilize that within your screen time. So at the end of the day, you need to be able to define one stock before you can define any, multiple stocks all at the same time. So my best suggestion for you is, as a new trader, focus on one thing. But it's the way that you focus. It's not like, for instance, the first thing on our list this morning was what? CHCI? Okay, so CHCI. We pull that up. If that's the stock we're going to focus on, we want to understand everything about it. We want to understand how it moves, what prints come out, and how it reacts, what its personality is, what its range is in comparison to what it's done before, its puzzle that comes in. But if we keep trying to look at 3 different stocks, are we ever really going to know as a beginning trader exactly what CHCI is showing us? No. So focus on one stock, but not just one stock that shows you we're going to get volatility within it. Because without volatility, guys, we can't trade. We need volatility. We need that volume to come in. Volume and volatility basically are almost the same thing. When you get huge volume coming into something, almost always volatility is going to follow. So focus on first picking out a stock out of the multiple stocks that are moving, and focus on that one specifically. Now, what happens if you catch yourself every time that you pick a stock, it ends up doing nothing? It sits in consolidation, it doesn't get volume. What does that mean? What does that mean? You picked wrong. Well, obviously. But what does that mean? Now we know where to focus. Okay, so the things that we're watching aren't giving us the best possibilities. So now that helps us define what we did wrong the first time so we can do it better the next day. At the beginning, I know everyone wants to make money. And as a trader, once again, money has no place in trading, but that's the reason that we actually trade. So we all want to pick the best stock. It just, unfortunately, it doesn't work that way. What we have to do is we have to find something with possibilities that can happen, and that's where screen time comes in. Because screen time, if I'm watching CHCI, my dyslexia today is terrible. If I'm looking at CHCI, right now, am I getting any screen time? Is this screen time by watching this? No, it's nothing, because nothing is happening. So what we have to do is we have to find something that's actually going to move and has a possibility to actually move. So as a new trader, the number one thing that you need to focus on is a stock that is actually going to move. That's really what you need to do, is be able to determine out of 10 stocks, what's my best probability? Now, keep in mind, best probability can be with your game plan. You might want a stock that's in the $25 range that, has a bigger range. You might want to trade cheap stocks. You have to focus on those individually, but individually you have to focus on one. So if I'm a new trader, is it beneficial to learn cheap stocks and bigger stocks at the same time? Is it beneficial? It's really not. They trade completely different, don't they? Which one's actually easier to trade? Which one's easier to trade? Yeah, the bigger stocks. Why? First, they have a bigger range. Okay. Second, more expensive stocks typically are going to move more, obviously. So starting there is actually going to help you understand cheaper stocks better. So it's really about setting up your game plan on what's the best way to get things done as quickly as possible. So you have to understand a stock that trades thin orders and only shows you a certain amount of prints is a lot easier to read than a cheaper stock that's trading 4 million shares a minute. So what it comes down to is breaking it down. The first thing I would suggest is and when I say expensive stocks, I don't mean anything over $100. I mean, in the 25 to $75 range, somewhere in there, because we have to be able to understand how stocks move first before we can go into the cheaper stocks. Cheaper stocks, like I said, are a completely different animal. All right, it's going to be a lot harder to read. All right, so as a kid, do they give us The Tale of Two Cities first to read, or do they give us picture books? As you're learning as a kid, which one do they start with? Are we going to learn Shakespeare in first grade? No, of course not. Because if they started with Shakespeare, there's just no comprehension yet. But as Jason just said, the Cat in the Hat gives us the ability to start being able to read the harder things, because we're learning the easier words. We're learning how things actually work. So in the beginning, you want to look at things that are easier, because the things that are easier are going to help you develop into the things that are harder. At the end of the day, guys, an easy stock to read, 50 cents on that is the same thing as 50 cents on a stock that's really hard to read. So really what it comes down to is starting with one stock and starting with easier stocks. Don't try to just jump into the hardest stock in the world. I mean, for instance, Siri. I always bring this stock up because it's always such a great example. And obviously it doesn't trade it, and I know it's a quant. But if you tried to start tape reading and learning tape reading by looking at Siri, what's going to happen to you? Well, you're going to get overwhelmed. You're not going to have any idea what's going on, and it's almost impossible. And that's, obviously because it's Siri, but there's other stocks that are just as hard as this. When a stock starts off in the morning with 30 million shares, is that the best stock for you to look at? When you have a huge pre-market, it's trading almost like it's trading at the open. Is that a good stock to start with in the morning if you're in the beginning stages? I don't care if it moves $1 million to the upside, doesn't matter. But it's not, because of the fact it's going to be way harder. You have to start easy, and basically, you just like, when you go into a pool. Okay, you dip your toes in first and you kind of ease yourself into it, and that's the exact same way that trading works. So what you want to do is you want to find the easier stocks that have thinner orders. Now, I'm not talking about trading right now. I'm talking about the actual screen time. But stocks that have thin orders are way easier to read, because when you get a show of hand, is there any question? No, because if print personality is 1 and you get 4 prints, it shows, it tells you exactly what's going to happen now. So start there and then move yourself along at getting better at the harder stocks. But in the beginning, start with 1. Make sense? Beautiful. And then as that, guys, you're all gonna feel, you're gonna start to get the feel. Eventually one stock gets boring. I don't care how much it moves. One stock's gonna get boring. When it gets boring, start with two. Okay, and then when two gets boring, start with three. Now, have I ever really been able to get over six? Not really, just because I don't have enough eyes, to be completely honest. But at the same time, it's going to, it's going to help you develop your mindset, and that's really what it comes down to. Make sense? All right, beautiful. Next question. All right. So for someone in the beginning stage, less than 1,000 shares, should I record trade breakdowns immediately after the trade or focus on finding the next trade to maximize my time at the screen? How much time energy should I put reviewing my trades from a psychological perspective versus a process perspective? How do I get better at anticipating triggers while they are forming rather than after they occur? All right, so first let's break it down. First, for someone in the beginning stages, less than 1,000 shares, should I record breakdowns immediately after trade or focus on finding the next trade to maximize my time at the screen? So the way that I used to do it is I break it down into time frames. All right, so in the beginning from 9:30 to 11, are you ever going to get any better screen time than that? Are you ever going to get better screen time than from 9:30 to 11? More than likely, no. Now that you have the occasional day where the afternoon is better than the morning, but that's typically not what's going to happen. All right, so I used to break it down. So 9:30 to 11 is my screen time. When things slow down, that's when I would start journaling my trades that I did for the morning, because there's no reason to waste screen time as that's happening. But if you don't take correct notes, there's going to be a problem, because you have to be able to remember exactly what's happening. Does that make sense? You guys understand what I mean? It's very, very important to make sure that you're writing down your notes, your prints, and or remembering. Now, does that mean that if you're in the beginning stages, you make your trade at 9:35, you can't journal it afterwards? No, but screen time is one of the most important things that you're ever going to get. The one thing about trading is, can you get screen time after 4 o'clock? And someone's going to say the pre-market, aftermarket, but obviously I understand that. But you can't get back screen time. So you're always better off paying attention to what the stocks are doing during the times that they're moving. And when things slow down, that's when you want to start journaling everything that you have. Always maximize screen time. Okay, the more screen time you have, the quicker you're going to develop in this. So in the beginning of my stages, I would always wait until things slow down, but I wouldn't wait till after the market is closed, because then so many things are going to run together. So as soon as things start to slow down, there's not really many trades. That's when I would suggest that you start doing your journaling. Now, how much time and energy should I put reviewing my trades from a psychological perspective versus a process perspective? Which one's more important? Which one is more important? A psychological perspective or a process perspective? What do you guys think? So we have a psych. You guys aren't sure? They're both equally important, because not for nothing, but a psychological perspective versus a process perspective, is either one deserve more of our attention to? Think about it. Because at the end of the day, psychologically, let's say you let a trade just go against you, okay? So right there, that basically broke your process perspective, okay? But psychologically, we need to understand why we broke the process, because the process is driven by psychology. Our processes all are driven by how our mind reacts to it. So there's no one that's more important. They need to be focused on, and exactly like you said, two sides of the coin. Okay, there's those two sides of the coin. You can't have a coin without both. Okay, both sides have equal weight. Well, technically it's a little bit less, but both sides have equal weight. So we have to focus on both of those. All right, but one comes before the other. What drives process? And as we just talked about, as Matt just said, psychology drives the process. So it's not that we focus on one more than the other. It's that we start with psychological and then we go to the process. Both equally important, but psychology comes before process. Because in order to have a process, what drives a process? At the end of the day, what's the big thing that drives a process? As a human, obviously, not, what controls process? Yeah, your brain, your mind. Okay, process is only as good as your mind making the process. Okay, but the process itself, we have to focus on just as much because of the fact without the right process. And it goes back to the question that Jerome asked before, and it says, with the multiple how regular training practice makes perfect, but to me, quality practice is better than quantity practice. So if you're not focused on the process and you're only focused on the psychology, but you're focused on the wrong process, you're never going to get where you need to be. So both of them are equally important, but the psychology comes before the process. It's just the way that it works. One comes before the other, but they're both equally important. Because first of all, we have to figure out our psychology. Okay, if we keep leaving, let's say we get into cheap stock and it goes way against us, and we don't cut our losers and we keep leaving it there. Okay, that's psychology and process. The psychology of that is what? When you hold a loser and you don't cut it off, what's the psychology behind that? Every person is exactly the same. Bad. Hope. That's it. Hoping it comes back. So psychologically, you've went away from process and you're just hoping that it gets better, right? You're scared to lose money and you're thinking of money. So there's two things there. There's one is psychologically, we're money minded. And money minded is one of the worst things that you could be in trading because of the fact that trading and money have nothing to do with each other. It's a process. But that's the reason, that's the psychology behind the reason that someone's going to hold on to a loser. All right. But the process itself, you're breaking your process, aren't you? So when our psychology is wrong, typically, can our process be right? If our psychology is wrong, can our process be right? No, not even close. But if our psychology is right and our process is wrong, can we be successful? Statistically speaking, I guess you could get lucky a lot. Okay, so if our psychology is right, our psychology is wrong, excuse me, can our process ever be right? Psychology is wrong, can our process ever be right? It cannot. If our psychology is right, but our process is wrong, can we be successful? So technically, the only way to, basically put these things together, they both have to be put together. That's really what it's a relationship that comes into it. Because even if your process is right and you know your process, but your psychology is wrong and you're not following the process, psychology helps us follow process. Do you see what I mean? But without psychology, can we, even if we know the correct process, can we accomplish it? Does everybody here, and hopefully the answer is yes, know what the most important part of trading is? What is the most important part of trading by far? cutting your losers. It's that simple. Okay, so we all know that in the process, correct? That's a simple part of the process. If we do not do this, we are screwed. We will not succeed within trading if we do not cut our losers. Most important part of trading. But what causes us to cut our losers? The process tells us that we need to cut our losers, but what actually causes us to click the button? Psychology. It's a synonymous relationship. Without one, the other doesn't work. If you have one, it's not enough. You need to have both. So you need to have your psychological perspective, and you need to have your process perspective. There's no one to focus on more. It's the psychology just is what drives the process. So we need to focus on both, but which one do we need to focus on first? So if you're going to write your journal, there's psychological and there's process, which one goes first? In your notes, which one would be the first that goes? Psychology. And the other part is the process. So how much time and energy should I put in reviewing my trades from a psychological perspective? And as we just went, and how do I get better at anticipating triggers while they are forming rather than after they occur? All right. What's the answer to that? What is the answer? How do we get better at anticipating triggers? It's 2 words. 2 words. Well, doing it, which is 2 words, but that's not what I'm looking for. Screen time. Screen time. Our first class tomorrow is on possibilities. All right. We need to understand when we see a stock move. Okay. We could go to AUVI right now, and it's a perfect example. We have to understand the possibilities. And it's as simple as just getting into the consolidations. Rich, I just signed up for classes. I'm pumped to get back in. I'm glad to have you, Derek. It's going to be a good time. Well, but we're in a consolidation. Like I said before, it's not this simple, but it really kind of is. So in a consolidation, there's 3 possibilities. Okay, it's going to either continue to consolidate, it's going to break out above, or it's going to break out below. Those are the 3 possibilities. Now, there's false break. I mean, there's, but in the 3 main possibilities, that's what it is. So if I have beautiful prints up here, okay, let's say at 29, I have beautiful prints, and the stock's in consolidation right now down here, and we're getting buying in that consolidation. Guess what? What do I have to be ready for? Where should my order be? Ready for the trigger to break the consolidation. So that's why screen time is so important, because screen time isn't just reading prints and sitting there. It's watching what stocks do. All stocks trade pretty much the same. Now, yeah, you have those crazy ones that have these huge ranges, these exceptions, but the exceptions aren't what we get rich off of. What we get rich off of is things that happen over and over again. So when we see something continuously happening, this time, and it happens to a high percentage, that's how we anticipate triggers. It's knowing the exact possibilities of what could happen, and knowing which possibility has the higher percentage of happening. Because if the lower percentage, let's say it's 30-70 to the upside, so 70% chance of it jumping up, 30% chance of it going down. Where should my order be, up or down? Or order ready? Where should my order be ready, up or down? Up. If it breaks down to the downside, who cares? Because if it breaks down to the downside and it was a 70% chance of it going up, are we probably going to get another entry to go back up? Absolutely. So anticipating triggers all has to do with understanding how stocks move, that screen time of seeing it happening over and over and over again. I'm looking at VERU right now. Okay, I know exactly what this stock is. Okay, what would I say about this stock? How would I define this stock right now? I'm a sucker for it. Smooth. So I know what smooth stocks look like. Do smooth stocks stay smooth forever? No, not even close. So I know the possibilities. When a stock is too smooth for too long, the possibility is the higher percent chance it's going to go against it. Because if it's too smooth for too long, that means that retail gets to make money. Retail does not get to make money for an extended period of time. It just does not happen because they cannot build their positions that way. So anticipating triggers has to do with understanding how stocks move and then applying the prints to exactly how it's moving. And this is such a phenomenal question. This is a whole class that's coming up this week. So we're gonna have a field day with this stuff. I'm gonna tell you guys some stuff that you've never even heard of before. And we're going to get further. So I'm not going to go too much further into this question, but that's what it is, guys. It's understanding how stocks move. Because stocks moving, does it have anything to do with prints? Of course it does, because prints move them. But I don't even care. If you take the prints away and just watch a chart, that's what I mean by how stocks move. Okay, when you get a staircase, okay, look at the beautiful trade right here. You get a staircase coming at 22, doesn't hit, pull back up. That's how stocks move. These patterns, these different types of patterns. So screen time is what basically ingrains those patterns into us. So from there, we can decide what the best possibility is. When a stock barely pulls back, guess what? Well, I'm not looking for a pullback then. I don't want to trade a pullback because it barely pulls back. That's what it showed me. So I know that after basically 10:30, if a stock really hasn't pulled back much, I know more than likely it's not going to. So when it does pull back, I'm looking for the upside trade rather than the downside trade. But when we have a stock that does pull back, then we go the opposite. And once again, like I said, we're going to hit this really, really hard. But just a little intro into what we're going to be talking about. All right, makes sense? Beautiful. All right, next question. So when a stock comes to a level and starts to take out the order there and bounces off the level, what reaction are you looking for if the market maker has intentions to take the rest of the order out or not? I'm looking for the off-level reaction, but sometimes we won't get that, especially with a stock that has thin print personality or parabolic move. So where do you look from there? So the first thing to look at is if a stock takes out it goes up into an order and doesn't take it out all the way. What does that tell us? Every single thing that happens is for a reason. Stocks do not just move for the hell of it. If there's no one trading it, sometimes they'll move for the hell of it because there's just a little bit here. But there's no real moves that happen for the hell of it. There's always someone that's going to be there. So if we come up into an order and they don't take the full thing out, why? Why didn't they take the full thing out? Not fully interested in that price. All right, so let's start with a different part. What if they do take the whole thing out? How do we interpret that? So let's say we have a huge order sitting here at 21, comes up, takes the 100,000 share order out. So they're maximizing, but what are they actually doing, Eric? Remember what we talk about all the time, when they take out these huge orders, who's typically doing it? Readjusting inventory in the house. Thank you, Chandler. That's why Chandler got a shirt last class. But that's exactly what it is. So they're readjusting inventory in the house. If it only hits a part of the order, is that them readjusting inventory? It's not. What does that tell us now? What happened that it only took out part of the order? What was the reasoning? Someone else. There was someone else that came into there and they wanted shares there. It's not the same as someone readjusting, because if someone's readjusting, that means the stock needs to go up. Okay, we need to go up quick. If someone's just buying there, then we're going to take it as exactly how those prints showed. So they still have the same result. They still mean up, but one of them is new interest compared to readjusting orders and readjusting their positions, readjusting their inventory. So it tells us a different thing. That means the person that's already in the stock that put that order up there, all right, is looking to get out of a portion of it. But then when that some person buys, now we have to focus on that person rather than the original people that were in at the lower prices. Do you guys understand what I mean? Is everyone clear what I'm trying to say? because this is important. If you're going to readjust, okay, you're going to readjust your position. Okay, let's say I'm in the VERU at, I don't know, let's say 14. Let's say this morning, I built a bunch. I'm in at that 14 level. Okay, we get this, this jump up that comes into it. That's great. Now we're coming back to 21. Okay, and there's 100,000 shares there. If I'm going to readjust my inventory, am I going to hit the whole order? Or am I going to slowly hit it? I'm just going to hit it. I'm going to readjust my inventory. I'm going to take my order. I'm selling my shares to myself, essentially. But what happens is that if it doesn't hit the whole order, that means they're not looking to readjust. What happens is that level is now showing you how much interest is actually there. So based off the amount of the order that gets hit, shows you how much interest is sitting there at that level. Now let's think about the market maker that put the order there. If I put a 100,000 share order and 70,000 gets hit, what does that tell me? It's pretty big interest, isn't it? All right, so now I know that retail and other market makers are at that level trying to hit this. So now I know there's a huge interest of this stock going up at that level. If I know there's a huge interest of the stock going up at that level, what am I going to do? As a market maker that's actually in from the beginning, what am I going to do? If I know there's huge interest at a level and a bunch of people just bought into it, what do? Oh, I'm going to take everything. It's my turn now. I'm going to drop this. Okay, now we're looking for a number one trade because I'm going to drop this hard and I'm going to take away. Now, when we get the whole order hit, what's the difference now? Am I trying to steal shares? Or am I looking for my inventory to now be at a higher price? Higher price, right? So that means the time frame is completely different. Okay, everything comes down to psychology. It's who's behind the other computer, what the prints are actually showing us. So if I'm readjusting my inventory, I don't need to build that much because when I readjust at that point, I want the stock to start going, right? I want the stock to get away, just like our mission statement is. We want the stock to get as far away as quickly as possible. So we know it still needs to pull back, but the pullback, the next trigger to the upside's way higher percentage. If it only hits part of the order, the next trigger up isn't very high because it's money time for me. Well, when I say money time, it's building time to take those shares away. So we can now, talking about before the last question about how to anticipate triggers, we have a whole new idea now. So the same 100,000 share order, the way it gets hit tells us everything. If I'm readjusting my inventory, I want it to be up high. If I see there's a big interest, I'm taking money. And that's how it works. Make sense? Beautiful. All right, next question. All right, HTBX was the number 2 trade we had this morning in the chat room. There was off-level selling at 1465 and selling reaction as we were coming down at open. We consolidated momentarily before the release that was called out almost to a T. I was wondering if you weren't in the stock at the time of those prints, but from the timing it's coming when you are getting an entry since we want to stay clear of entering during consolidation, or is this a field type trade? All right. So let's start with that, 1465, okay? Real nice off-level selling at 1465. What does that tell us? Start right there. What do we call that? And I know this is kind of like contradictory. So not money time, well, kind of, but what is that actually telling us? So is 1465 now prints? What would be the difference if it was 1465 versus 1463? What would be the difference? So delayed short term, Eric, and that's the part of what do I say? The long short term, longer short term coming into it, but that's delayed short term. Why? Because it's at a 0 or a 5. So basically at that point, what we're going to be looking for is a little bit of a pull up that comes in, and then the first trigger down, boom, we're ready to go. Well, the stock is ready to go. I mean, depending on what the situation is, it might not be a trade yet, but it's basically telling us that it's time to go. Right? So that 1465, as soon as we see that, we know the stock's going down in the short term, but it's a longer short term. What it's going to do is it's going to show us that the stock needs to pull up first, but the time frame for the trigger down is going to be short. So when I see something like that, if I'm selling below, I'm basically, as the stock is going up, I'm just changing my order to where I think the trigger is going to go. And the trigger is going to go, the second it happens, boom, we click the button. Okay, so that's not a field trade. Okay, well, I mean, technically it could be a field trade if there's not prints, but the selling that was coming into this was really big. Now, I was in this trade. I mean, HCBX needed to pull back. As remember, when we came up to that 1850 level, we talked about how it needs to have a substantial pullback. If it broke past this building phase right here, we had a while to go back towards the downside. We talked about it in our morning meeting. So when we see something like that, it's literally telling us longer short term. But if it was 1463, it would have told us shorter long term, short term. I know that it kind of gets confusing, but back to what Eric said before. I mean, it's delayed short term. Make sense? So I know the timing is coming because of the fact when that happens, all I'm doing is I'm just ready for it to go down. That's it. I don't know exactly when anything is going to happen. That's not true necessarily. There's some other things that come in that where I do know when things, but for the most part, I know what needs to happen and I know what it needs to look like. And that's one of the biggest things possible is I know what it needs to look like. And as long as I know what it needs to look like, I know what I need to look for. So when I see those 1465 prints, all I need is a little bit of a pull up, and then guess what I do on the first trigger? What am I going to do on that first trigger? I'm going to take it. It's a trade that comes in. So when you get prints like that, when you get those big prints that come in, those off-level selling, they still need to follow the rules, but the time frame is completely different. Controlling prints can build forever. When you get the shorter, the longer short-term prints, that basically tells you your time frame is coming. And when your time frame is coming, you set your orders up and you're ready, and you sit there, and the second it comes in, that's when we take our trade. Make sense? And again, we're gonna drill this in our classes that are coming up, but that's how that needs to be interpreted. Hey, Rich, good to have you back. My question this week is on our two mental states while in a trade, offense versus defense. When coming up to a psych level, my mindset goes into defense and I start to scale out rather quickly. What variables or situations tell us we can flip back into a more offensive mindset near a psych level? Thank you for your time. All right, so this is a great question, phenomenal question, Chandler, as usual. So offense versus defense. When do we not have to be in defense? As a trader, when do we not have to be in defense? Never. We're always in defense. The best traders in the world, they don't give a shit what they can make. They care about what they can lose. You are never not being defensive. Okay? So one of the answers was money time. Okay? When a stock is in money time, what's a better time to bring it down? Money time means who makes money. Obviously the market maker, but who else makes money during money time? Retail. How long does retail get to make money? Short time frames. Everyone's just enough to keep them in the market to be able to keep giving their money away. I hate to say it that way, but it's the truth, and I'm not going to lie to you. Okay. So at the end of the day, we're always in defensive mode. But what it comes down to is the prints themselves. The prints, short term versus big term. Now, if a stock is coming into, let's say, 15, should I take off shares regardless of what happens? Regardless of what's happening, should I take off shares just because a stock is coming into 15? No, not necessarily. Just because the stock's coming into 37, should I take off shares? What about 37? No. What about 65? Should I just take off shares because the stock is coming to 65? Don't be afraid to answer. No, absolutely not. Because now what happens is as we're coming into one of those levels, we got to see what's going on. If volume is decreasing into a level, is that a good sign? It's not. So what mode do I go into? Defense. Okay. Now a stock that has great volume coming into a level. Still defensive, but am I going to take off anything yet? No. Let the level show you ease up on the defense, and that's the best way to put it. But let the stock show you what it's going to do. One of the things, everyone thinks that I have a crystal ball. I don't have a crystal ball. I just watch time and sales. So as we're coming into, let's say 15, we'll use 15 just for easy numbers. That comes into it. I got great volume and I got beautiful ballsy prints right underneath 14. So I just take off to take off? Nope. I come up to 15, volume's low, I don't get anything, then that's a spot to think about taking off. But we don't take off until somebody shows us it's time. Now, a lack of buying going into 15 is not a good thing, is it? No. So I'm ready to take something off, but I'm going to give myself a few cents because I'd rather see it 15. Now, if we get ask prints at 15, what do? Yeah, now I'm going to start looking to take something off. I'm going to lock in some profit because it's not showing me that it's time. It's not showing me that we have the room to be able to continue to go on. One of the easiest ways that I'm able to manage multiple stocks at once is that I just set spots. And that's really what it comes down to. So let's say I'm in this stock and, it goes up to 15. Okay, at that 15, I'm only willing to lose a certain amount of profit. So I have to decide, is the prints that just showed me, is it going to break the amount of profit I'm willing to lose? Okay, so if you're in for, let's say, make it easier. So you're in from 14 and the stock goes to 15. That's $1. Anyone willing to lose 50 cents of their dollar profit? Anyone here willing to lose 50 cents? No. That's 100%, that's 50% of your profit. That's crazy. Okay, we would never do something like that. So if I come up to 15 and I get 2 prints, do I need to take off a lot? Get 2 ask prints at 15. Do I need to take off a lot? No. So now I just have a set spot where I'm not going to let it go underneath because I know if it's going to continue to go, I'm statistically going to get another entry that comes into it. But now I get 15 prints at 15. How much do I take off? What percentage am I going to take off of my position if I get 15 prints? And I don't even know what it is, but let's say print personality is 5. I get 15 prints at 15. How much do I take off? Yeah, anywhere from 80 to 90% at that point. So not 100, not 100 yet. Okay, because I'm always going to leave a runner, right? Okay, but anywhere from about 80 to 90%. Why? Why am I going to take off that much of a trade when a stock shows me it's crazy bullish? 15 prints at 15, that's great. Yeah, because guess what? Those prints just told me, is the pullback going to go under the amount of profit that I'm willing to give out? So exactly, statistically, I'm going to get another entry. But on top of it, those 15 prints at 15, they're having a print personality of 5 prints. Is it going to pull back more than I'm willing to give away? It is. So if it's well, likely. So to a very, very high percentage, it's going to give away. I know it's going to break it. Guess what? Why am I going to let it break it first to get out of everything? No, I'm going to take off 80 to 90%. Okay, closer to 90 because 15 is huge compared to a 5 print personality. So really closer to 90, but depending on if there's some shorter term buy, that's one of the things we're going to talk about in detail in class. But I have to, because I know the prints here are now going to break where my spot is. So what if volume is really hot? It's a great question. Does volume have anything to do with how much a stock needs to pull back from our rules? Does volume have anything to do with the price amount it needs to pull back? Yeah, thank you, David. No, just tells us how quick it can move. If we get 15 prints at 15 and it pulls back to 1481, is that a good trigger to take the next time? Or a high percentage trigger? Didn't pull back based off of how much they showed us they were going to build. Now, don't get me wrong. If you get a huge amount after it pulls back, and there's stocks that are going to be able to continue up. Once again, I'm giving you kind of a cookie cutter, view of how we look at this. But if it pulls back, to 81, and all we get is 81 prints on the ask, and it shows us all short term, well, you know what? I'm going to take that trigger every day. I'm going to take it every single time. But we have to understand, as a newer trader, I've earned the right to be able to do that. As a newer trader, if we get 15 ask prints at 15, how much does this stock need to pull back? So I wouldn't start with $1 here. Why would I start with 50? Why would I say it has to pull back at least 50 and a trigger after 50 is okay? Even though it shows it's moving in dollar increments. Why would I say that? These dollar amounts, where are they coming from? In all reality, how this stock is moving, where does the dollar increments come from? And I moved the chart back for a reason. Yeah, see, from 8, when you go from 8 and push up to 1950, okay, that's where these dollars are coming from. So what we have to do is we have to kind of see how it's been trading. And the way that it's trading, it's not really moving in dollars. It's really 50. Because once the market opened, it's showing us something different. So we would start with 50 cents. Because, one of the things we have to understand is that, that's an easy way to look at the side of your chart and see what increments is coming in. But where did those increments come from? Exactly, Eric. This one is skewed. And it's phenomenal we have a stock up right now because that's a huge thing. But the increments are skewed. So when we have skewed increments that come back into there, we have to kind of look at what it's doing. And if we really look at it, it's really moving at about 50 cents. So offense versus defense comes from supporting prints. If we have the supporting prints, it changes everything. If we don't have the supporting prints, we only have controlling prints, it changes everything. Each situation is going to be completely different. And this is something, again, I can't wait for classes. We have a lot of things that we're going to be going over, but that's really what it comes down to. Make sense? Beautiful. All right, next is recently I've been doing very well, but I want to make sure I keep doing well. I feel like this kind of thought process might be scary, scared money and hurting me overall. How do you train your mind so that you are a consistent machine? Someone give me the word. How do we make ourselves a consistent machine? How did I take a bunch of days off, come back to the market today, and have no problem whatsoever? And as David just said, process. Okay, you're focused. So recently I've been doing well, very well, but want to make sure I keep doing well. Okay, what is the focus on? Sorry to pick on you, Matt, but I have to. What is he focused on? Outcome. He's focused on outcome. Okay, one of the biggest things why people do so well and then hit these big downsides is because they get cocky. They go from being focused on process and just trading what's happening to be worried about outcome. Okay, one of the scariest things you could ever do is make a lot of money. Because once you make a lot of money, do you want to give any of it back to anyone? Human nature. Okay, I'll give you a great example. So in 3 weeks, moving to South Carolina. All right, just bought a bunch of houses. My cousin just literally, I just helped him move in this weekend. All right, so as we went into there, he was completely focused on this brand new life. But he had a house in New York. And he bought his house in New York at $300,000, $312,000, I believe it was. I hope he doesn't hear this. He would kill me if I told you guys this. But he bought it about $312,000, and he sold it for $500,000. That's how much it went up in 8 years. So so obviously he has to pay the bank back, whatever. But they basically transferred about $200,000 into his account. All right, so my cousin, he's always done well. He's always had money, but he's never had $200,000 in cash sitting in his checking account before. So one of the first things that he said to me was, I don't want it to go down. So brand new house, his 5 bedrooms, it's gigantic, 2-car garage, absolutely beautiful. But his furniture broke. So his bedroom furniture that was being shipped from his old house went to his new house. All right, and everything, the entire bedroom set got destroyed inside the truck. He didn't want to buy a new bedroom set. He wanted to try to fix it. Guy just had $200,000 put into his account and didn't want to buy a new bedroom set. Now, think about it psychologically. Why? Why didn't he want to buy a new bedroom set? Because now he sees $200,000 sitting in his account. He doesn't want it to go down. So instead of doing what he would normally do before he had $200,000, he'd just buy a new bedroom set. But because now there's this big sum of money and he's doing really, really well right now, didn't want to spend $1. Isn't that crazy? So when he was living comfortably, would buy it. But now that he's living pretty good, doesn't want to buy it. And this stood out to me. It was something that kind of just hit me in the head. It's that the better we do, guys, the more afraid we are of going back. How do you break that? How do you buy the new bedroom set? How do you buy the new bedroom set? That's it. Process. Back to the process. Okay. I don't look at my P&L till Friday. Don't care. Okay. It doesn't mean anything to me. Oh, there's been a few times. We've had some crazy ass days where it's been the best days that I've ever had. So that's a little bit different there. But at the same time, for the most part, never look at it because the money doesn't mean anything. Because all I do every single day is what? Trade the process. Day in and day out, I trade the process. I don't ever worry about going back. I don't worry about big losses. I don't worry about anything because it's just a process. That's it. Nothing affects anything. And the reason I told you guys that story is because I want you just to understand the human mindset is why people get they get so successful and then get crushed. And the reason is because they're not trading their process anymore. Once you make a lot of money, okay, and you have money for the first time, a big, large sum of money for the first time, what goes out the window? What ends up going out the window the first time? Process. Okay, our process, because now what are we focused on? You have a great week. Let's say you make $100,000 this week. Yeah, now you're focused on outcome. And it happens to every one of us. All right, it's basically what in the beginning stages of trading, until you get to a point where it's just so process driven that nothing else matters. Okay, you take 5 steps up, 3 steps back. Okay, 5 steps up, 2 steps back. 5 steps up, 1 step back. And that's the thing, is that it's ingraining the process, because when you're outcome driven, the outcome of him buying a new bedroom set would do what to his bank account? More money than he's ever had in his life. Bought his bedroom set when he didn't have tons of money. But now he's got tons of money, doesn't want it to go back. So essentially, what happens? Well, you start trading out of fear. Because I'm going to tell you something, guys. Some of you have seen this, in real life, but this is life changing. Okay, this trading is life changing. When you get this, guys, the money. I still, to this day, this very day, I'm still in disbelief at what happens. But that's why I don't pay attention to it. Because if I paid attention to it, I'd be in fear. It's all about the psychology part of it. And remember, psychology comes first. So when you make a lot of money, you don't want to give it back. But if you don't want to give it back, that means you're fearing outcome. You're not process driven. So the best way to get out of that is to just every morning you wake up, process. The first word out of your mouth should be process. You sit down at your desk, process. Okay, you make your bed, process. You take your shower, process. You brush your teeth, process. Don't fear loss, and that you just answered your own question, and I couldn't say it better myself. Don't fear loss of capital, fear loss of process, because the loss of process is where loss of capital comes from. That story reminds me of a flow I once had. Would project the capital from the day and miss trades. Exactly. It almost comes back to, I know, we were talking. Oscar asked this question before, and it's like, when you hit a certain amount, should you stop trading? Well, if you're process driven, would you ever stop trading? No, not a chance. But if you're outcome driven and you hit your outcome, well, now you're not going to pay attention the way that you should be. Okay, it goes right back, and I'll even pull it up again for you guys. It goes right back to exactly what Dave had posted. And when I saw this, I was literally sitting in a hotel, and I just absolutely loved it. But the process versus the outcome. I don't care what the outcome is. I know what the outcome is going to be to a percentage. So I don't care if it goes up, and it's a 70-30 trade. It goes up, great, 70%. Goes down, I cut my loss. Okay, that's the process. That's all it is. The process is assigning percentages to things that are going to happen to a certain percentage. That's simple. So the best way in the world to not be scared money is, number one, stop thinking about money. How do we stop thinking about money? Be process driven. All right, guys, that is the end of our questions. Any questions? Do you think there truth in having more money, you worry about money less? Do you think there's truth in having more money? So one of the things, Derek, that I noticed, the more money that you have, the more money you want. Somebody that, and that's, I guess, if you focus on the money part of it. But having more money, you worry about money less. Now you just get more bills, to be honest. That's really what it comes down to. So Derek, I'll tell you. So when I went from when I took a $30,000 account to over $100,000, I was still pretty scared. But it gets to a point where your process just overrides it. To be completely honest with you, so I remember after I got 100,000, I can't fall below 100,000. I can't fall below 100,000. Guess what I did? Almost immediately, guess what happened? I fell below. I almost immediately fell below because I was thinking I was, trading, and that's the thing that we have to understand is none of us are perfect. None of us are born this way. Okay, the process is what develops our mind into doing these things. So you can't worry about stuff like that. It's process. So at the end of the day, guess what? The easiest way to not fall below $100,000 was to trade my process, and was to, when I saw a great percentage trade, throw the kitchen sink at it, and when it was a lower percentage, use lower shares. Okay, but when you start to focus on the money, it gets easier, guys. It becomes a video game, and that's really what it is. It takes years, okay, guys. This is I was just looking at it. This is going to be I've been trading for over 11 years now. Okay. This didn't happen until like year 5, where I was, to a point where I was just so focused on the process, I didn't care about money anymore, because there's always a little bit of that thought in the back of your mind. So don't be upset about it. But what you need to focus on is the process. Because if you're so focused on process, can you really focus on anything else? Is it really possible to focus on anything else? No, not really. When this happens, I do this. Okay, beautiful ass prints at 15. What number trade, guys? 15 ass prints with a print personality of 15. What number trade? 1. Process. That simple. There's no other thought. If it starts running to 180, well, I might find a trade within it, but guess what? It's not a number 1. Doesn't fit. You know what I'm saying? It needs to be looked at as a trade. That's it. I don't care if you have 1 share or 1,000 shares. 1,000 shares just means that you still have emotions in comparison to things. All right, guys, that is it for me. I will talk to everybody in the chat, and happy trading.